Hey guys, what's going on? I've been getting a lot of requests about, Leo, tell us what the market's going to do next. Leo, tell us how to trade this thing, man. We want to put some trades like your students do, taking 20K to 258,000 in a matter of a couple of weeks. Guys, this opportunity that we're faced with right now is actually way better than 20K to 258K. This opportunity right here, if you pay close attention to what I'm about to show you in this video, what I'm about to do specifically, I'm about to show you the great divergence, both from a fundamental and technical standpoint. I'm also going to show you a precise historic analog of what actually happens next in the stock market. So this video is highly useful to you if you're a long-term trader, meaning you're trying to figure out what's going to be happening in the market for the next 12 to 18 months. It's also highly important if you're trying to decipher what's going to be happening in the market in the next 30 to 90 days. If you've been following 13 market moves for a while, you know that we are very good at finding historic analogs that will reveal what will actually happen in the market next. And in this particular video, we're going to show you the exact time frame in the history based on multiple characteristics, which I will break down to you, that will pinpoint to a high probability of what will actually happen next. So if you understand this, if you understand the correlations, instead of trying to put together 100 charts here and make it into a 5-hour-long video, I'm going to try to nail it in 20 minutes. So I may not be going into as much detail as I'd like to on some of the subjects I'm about to discuss. But bottom line is, if you're trying to make money as a trader, short-term or long-term, okay, there's some insights that are going to be highly useful to you here. So let's go. The recession is already here, while most of the Wall Street analysts are still blind and clueless. And the reason I got this particular side in green, guys, is because current market conditions represent huge money-making opportunities, and definitely not on the bull side. So if maybe you predominantly have been able to make money as a bull in the last few years because, hey, all you had to do is just buy the fucking dip, okay? You may find yourself in a situation where buying the dip no longer works, or no longer works based on the time frames that you've been successful with. So understand, for every bounce there is a drop, for every drop there is a bounce, but there's certain instances where, especially if you're playing short-term against the market, those are going to be your most lucrative opportunities. And I'm about to break all of this stuff down. So if you've been a bull, pay very, very close attention, because the money you're about to make on the short side, meaning profiting from when market drops, okay, it's going to make your gains as a bull make like a penny in relation to a million. So, I mean, forget about all these bullish profits, okay? Trust me, there's not a bull ever in the history of the fucking stock market that have out-traded a bear based on percentage basis. And this goes against everything that you know, because naturally, most of the people that are naturally bullish, but it has always puzzled me, because you cannot cheat the simple math. You cannot cheat the math in weekly options. Okay, things drop a lot faster than climb higher, and it takes things for a lot longer time frame to climb higher. So when we're talking about specifically trading options, okay, this market conditions that we're facing right now, extremely lucrative. So if you've never made money when the market actually drops, pay very close attention. And if at any point, if you go through this information, you still have questions, feel free to go to 13marketmoves.com, schedule a 20-minute coaching call with a senior trader here so we can actually help you take advantage of these right market conditions. So this is what's about to happen, okay? The question you should be asking as a trader right now is, what happens when Fed money printing machine breaks? Now, this is a crazy question to ask, because clearly the objection to that would be, well, what makes you think that the printing machine will ever break? I mean, we've been printing money here in the United States forever and fucking ever, and it hasn't failed yet. So what makes you think that this printing machine will ever break? Well, there's certain conditions that are currently present that point to this fundamental flaw. So what is this fundamental limitation? What is this fundamental flaw? Well, the simplicity is this. I mean, so damn simple that Wall Street analysts just can't freaking look outside the box and see it. This is how the market has conditioned them to buy every damn dip, that they absolutely neglect the fundamentals. The fundamentals are such that no matter which debt you look at, whether you look at government debt, corporate debt, personal debt, it's at the highest fucking level, whether you like it or not. And government spending, which have been driving this economy through COVID, through the last couple of years, it cannot be maintained if rates go higher. As a matter of fact, I would argue, based on everything we research here at 13 Market Moves, is that if United States Treasury yields were to go above 5%, it will be Armageddon. And let me break this down. So currently we're looking at $30 trillion in debt, which some of it was financed at as low as a quarter point. Now, 10 trillion of these debt is short term, which means average term of that debt is about 3 years. If interest rates actually go up to about 5%, just in interest rates alone, we're looking, or the government is looking at spending $1.5 trillion a year. Now, to put this in perspective, the entire tax collection, okay, the entire tax collection for the government is about $4 trillion a year. So when you put this $1.5 trillion, if the rates go to 5%, okay, I mean, this ties up 40% of tax collections, which means you cannot spend as much on military, which that would be a devastating time to actually spend less on military. Biden just approved the largest military spending bill ever in the history of the world. So that would be very difficult to maintain going further from here if interest rates actually going higher. And certainly would be incredibly difficult to maintain it if interest rates, God forbid, move to 7.5%. Because then at that point, expenditures on interest rates alone annually looking at like $2 trillion. At 10%, you're looking at $3 trillion. And at 12.5%, it is absolute Armageddon. Okay, because at that point, when you combine the aftermath of what also the corporations are going to be going through, the government could actually be collecting less in taxes than what it would pay out in interest obligations. So this has never ever happened. So when we're talking about interest rates, a lot of times people will talk about 1980s, which we will glance about shortly. But this Fed that we're dealing with right now is nowhere serious about lifting these rates because they know that if rates go to 12.5%, God, if rates go to 10%, okay, it's over. There's going to be no Fed. I mean, this is a collapse of historical significance that we're possibly looking at here in not so distant future. So you may be highly skeptical of this, that I would actually predict an Armageddon here. And I think the only logical solution to this is that Federal Reserve will actually, after raising interest rates a couple of times, maybe a quarter point, it will actually slow down because they have no other alternative. So basically what I am saying here is the fundamental flaw is the government cannot service its interest rate expenditures if interest rates go above 5%. They certainly cannot maintain the government spending at the rate that they have been doing it over the last 10, 12 years. And if the government spending be mainly attributed for the lower unemployment, for the growth in certain sectors, if the government is not spending as much anymore, guys, all of this shit is going to slow down. It's going to slow down substantially. And therefore, we're looking at a totally different picture in the markets of what we're currently looking at. So when you combine this again, understand that when interest rates go up, a lot of companies that have been playing the roulette with the market, meaning they've been actually borrowing money. One thing is when the company is actually making money and they decide, okay, we're going to buy some stock back, which is still stock manipulation, whether you like it or not. But there are companies out there, because of simply of cheap rates, they went and borrowed a lot of funds and they bought back their stocks utilizing borrowed funds. Now, that never works out. It may work out for a little while, but it never works out at the end. So what I am saying, this sort of companies that did borrow money and went and bought their stock, they will have to pay those loans out. And they'll have to pay them while the businesses are actually slowing. So the only ultimate solution would seem to be for these companies is to actually sell their stock. So not all the companies actually went out and borrowed money to buy their shares, but the ones that did, they certainly not only not going to buy their shares back any longer, but they will also actually have to sell some because their profits are going to be slowing down due to high rates. So understand this. Essentially, what this means is on government level, the spending is decreasing. On corporate level, the spending is decreasing. There's less growth, which leads to less profits, which ultimately leads to less tax revenue. So when we go slightly back to this slide right here, current tax collections of about 4 trillion could actually go down to, let's say, 3 trillion or 2.5 trillion as the growth is slowing, GDP is falling, the unemployment is going higher. And I'm going to give you some figures to back it up historically why this actually has a high probability of happening. So while we have high interest rates and increasing costs of servicing the debt that the government has borrowed, the highest ever, 30 trillion. Guys, that's not a joke. And we're looking at a situation where, Jesus, Wall Street analysts, they're still saying there's going to be no recession. Well, simple facts. I want to break down first the stagflation, just to make sure we're on the same definition. We're discussing stagflation here. Stagflation is an equivalent of high inflation, growth slowing down, and higher unemployment rates. Now, a low unemployment rate would be 3-4%. Unemployment on the 5% rate would be basically a dream for most of the countries in the world. And so we're currently at like 3.8 on the unemployment. So unemployment is incredibly low. But the question to ask, what are the chances that we're actually about to roll into this stagflation type situation, meaning the inflation is going to keep going higher, given that we've got an 8.5% inflation number today on April 12th. I mean, we definitely have a check mark here. The slower growth, well, the earnings season is about to kick in, and I think this is also going to be a check mark. And guys, as far as unemployment, that's easy, okay? There's not much lower that you can go below 3.8%. That's about as good as it gets. So the probability of unemployment actually going higher above 3.8% is much greater than unemployment actually going below 3.8%. So I think we're going to be able to put a check mark here as well. So we got this check mark. We're going to add this check mark shortly when we see the earnings reports from a bunch of companies in the next few weeks. And we easily will add this unemployment, higher unemployment rates within the next month or two. It shouldn't be an issue. So we're going to have 3 check marks right here. We're going to be in a checkmate. It's going to be stagflation. And this is the beautiful part about it. Like if you're a trader, okay, like look at this goofball right here. All right, there's not even a hint of a crack in the labor market, says Jimbo. Okay, so this dude is absolutely clueless, okay, that he is the one He's one of the Wall Street analysts that's going to be losing his job. And he will be actually the reason why the unemployment rate is going to be higher. All right, this guy is absolutely clueless. Okay, as a trader, you shouldn't be looking, oh, well, this is what the labor market is right now. Well, good luck making money with that. As a trader, you should be looking at, okay, this is what unemployment is right now. What is the probability that from here, the unemployment is going to go higher or lower? And there's a 90% probability that unemployment is going to go higher from here, not lower. I mean, 3.8, that's about as good as it gets, guys. Credit Suisse, okay? There's going to be no recession until 2023, 2024. Dude, seriously, okay? Before it's too late, take 13 Market Moves chart course. Please, somebody, send this guy a link. Jonathan Golub, help him out. And I'm picking on these two guys because they were just recent. I think those were yesterday. But there's hundreds of these analysts, right? They're absolutely clueless. So my question is, okay, if this guy at Credit Suisse thinks that there's going to be absolutely no recession until 23 or 24, okay, how much is Credit Suisse going to lose based on this calculation? Guys, their losses are going to be fucking phenomenal, okay? And the fact that he's not the only one. I just happen to have a picture of this guy, but I mean, there's a ton of Wall Street analysts that are unanimous that there's going to be no recession for another year, another 2 years. And they're all fucking wrong because they can't look at a simple chart. So let's look at some charts here in a minute. So the point is, they're basing their conditions or their estimations or calculations on the fact that the unemployment is just so low and there's no cracks and everything like, okay, and the war charts after the initial drop in the war was supposed to move higher and so on. Guys, it's a bunch of bullshit. This market conditions, okay, resemble very few conditions in the prior 100 years. And we're going to point out exactly which conditions we should be focusing on. But let's get real. Unemployment at 3.8, do you really think it will go lower? Like 2.8% unemployment? Are you nuts? Okay, here's some historic data and charts from a historic analyst that points exactly to what will happen next. So the closest time frame in history, as far as chart pattern, as far as conditions, when we talk about the speed of rate increase, the level of unemployment, okay, the rate of unemployment increase that we could find throughout the history would be 1973. And what also coincides historically is the fact that in 1973, it wasn't Russia, okay, but it was Iran who, you know, we had an oil embargo with. So the story repeats itself, almost identical. Now, I want you to focus in because this is not the only historic example chart pattern-wise. And guys, if you don't know what a tornado pattern is, I strongly encourage you to go to 13mm TV and acquire Crypto Star course because it's going to show you exactly the criteria for the tornado pattern. It's going to help you nail some incredible trades throughout your trading career. And guys, this tornado pattern is insane. I'm going to show you in the next few charts here. But in 1973, basically focused on this time frame between April and October, and we've had 1, 2, 3. Basically, this is a tornado pattern before S&P 500 drops the hell out. Literally, like 50% drop. Guys, this is not a joke. This actually happened. A 50% drop in a time frame of 12 months. I mean, this is an insane drop that most of the people don't remember. Oftentimes we're talking about the 1929 crash, or we're talking about the 1987 crash, but this crash is absolutely phenomenal. And it's got a very clear chart pattern, which I'm going to illustrate to you is actually happening right now in the market. So remember this number, tornado pattern, followed by a 50% drop in the S&P 500 in 12 months. Okay, this is it right here. This is a thing of beauty. If you learn how to recognize this pattern, on individual stocks and cryptocurrencies, guys, your account will move exponentially higher. So all these examples that I'm showing you here in this video, print them out, post them on your fridge, put it in your folder when you're collecting data on the chart patterns. This pattern is deadly, and I would not bet against it. So let's move on. Just remember this number, okay? It's a 50% drop in 12 months after the tornado pattern. Now I'm going to break it down to you from the standpoint of interest rates. Okay, we're going to have to rewind all the way back down to 1973. And we're going to look at GDP, we're going to look at unemployment, we're going to look at inflation. So as you can see, in 1973, March 21st, interest rates were at 5.5. Okay, in that year, there was only a quarter-point rise. And look at these notes, right? Fed raised rate a quarter point to combat 3.4 year-over-year inflation. Guys, year-over-year inflation right now in 2022 is 8.5. And we're nowhere close to this interest rates of in the 5 handle. And please understand, when I'm showing you these interest rates, I'm referring to the Fed funds rate. Okay, I'm not talking about mortgages. The mortgages, 30-year mortgages are already over 5%. Okay, now think about what could happen to mortgages and house purchases in the world if indeed these rates were to double. Okay, we're still at like 2.7, 2.8 handle on some of these U.S. Treasury yields, but we're so far from these numbers that we had in 1973, but I want you to focus on these numbers right here. So the GDP was phenomenal. How often do you get a GDP of 5.6? Damn, that's a strong growth, 1973. Unemployment, 4.9. Okay, 4.9 is very, very low in unemployment. I mean, it's not 3.8 like we got right now, but damn, that 4.9, that's almost as good as it gets, all right? And inflation at 6.2%. So inflation of 6.2 would still be on the current levels in 2022. Now, fast forward just a little bit, okay? This is what happens next, okay? We've got, in 1974, look at this picture. Just look at it. From GDP of 5.6 in 1973, we go to a GDP and negative GDP in 1974. See, this picture is very rosy. Hey, looks like, hey, we're going to do a quarter-point rise in interest rates to combat inflation when it's 3.4. By the end of the year, what's 6.2? What did that 0.25% raise in interest rates do? Absolutely nothing. And look what happens to unemployment, right? So we went from almost perfect conditions, right? GDP at 5.6, unemployment at 4.9. Inflation started out at 3.4. I mean, these are pretty good numbers. These are pretty good economic stats. And look how fast they deteriorate, okay? So fast forward to 1974, we're at negative GDP. Damn, that's like 10 times worse. 10x worse. We're negative. Negative. From 1973 to 1974, GDP collapses. Unemployment, okay, almost doubles. Okay, so we're going from this rosy picture, right? Remember this guy? Let me just rewind to this guy. This goofball right here. I mean, do these guys not look at history ever? This goofball right here. There's not even a hint of a crack in labor market. Dude, please. Take some of our courses, all right? So, like, when guys like that, they look at a picture, I mean, he was probably, 21 in 1973, was like, damn, this low unemployment, a 4.9, GDP 5.6, there's not a crack in any of this data. Shit as good as it gets. And then the same guy, all right, next year, fast forward 1 year, oh fuck, what happened? Negative GDP, unemployment almost double, inflation from 3.4 to 11%. How the fuck did this happen? Because hold on, the entire time in 1974, what do they actually do? What does the Fed do? At 6% Fed's fund rate, this is where we enter the period of stagflation. Now remember, I showed you on the previous slide, we got stagflation is what? When you have high inflation, when you have unemployment increasing, and when you have growth slowing. So all of these factors are right here. This is just a quick summary, right? You have inflation from 3%, now jumping to 11%. You have unemployment from 4.9 when everything is perfect and rosy in the unemployment picture. Now all of a sudden almost doubles to 7.2. And you've got GDP from 5.6 just in collapse of an Empire State Building, minus 0.5, okay? While the entire time they've been raising rates. And notice, we kick into the period of stagflation when? When interest, on the second interest rate hike. Guys, we're not very far from second interest rate hike. Now notice, the first hike was a 1/4 point. Okay, the second hike was a 1/4 point between December 19th and January. There's another hike there. And then on February, 6.5. So we go 1/4 point, 1/2 point, and it's over, guys. It is over. Okay, and before you know, same year, you have a recession. So we're looking for another 2 rate hikes this year. First, we're going to transition into stagflation. Second, we're going to transition into a recession. All of that could happen in the next 6 months. So when these analysts are saying there's going to be no recession till 2023, 2024, guys, this is a perfect historic analog from 1973, 1974, almost a mirror image of what's actually taking place right now, with the exception of one thing, and that is the fact that the total government debt back in 1973, 1974, guys, it was nothing. I mean, it was under 100 billion. It was like 50 billion, 60 billion. Now we're looking at 30 trillion. Damn it, are you like, what? There's a huge difference. So back then, the Fed had the liberty to raise the rates. And as you can see, in the same year, in 74, you go from 6 to 11, and you still cannot contain inflation. And part of the inflation was the fact that there was an OPEC embargo. Okay, it all had to do with oil. Its exact mirror image was what's actually taking place right now in the markets with the conditions in Russia and Russian oil and Russian energy. So forward to 1975, the conditions don't improve. The GDP is still negative. The unemployment goes up. The inflation just a tiny bit lower. It's still high as hell. All right. Fast forward a little bit more. Okay. As you can see, the interest rates got as high as 13%. And again, the Fed does not have the liberty to get the rates this high, because I told you then the government the government's interest rates on the current size of debt is going to exceed the money that's actually taken in. And the only way for the Fed to actually service the money that they have already borrowed would be to borrow more. But they're not going to be able to borrow money at no 10 or 13% rate. So the Fed is in a checkmate. There's nothing it can do to get out of it. In other words, they cannot raise the rates in the shape or form they were raising in the 1970s or 80s. And the outcome of that is that inflation is going to rocket. Okay? It is going to rocket. And I'm going to show you some charts to back this up in just a moment. So at one point in 1975, you're like, okay, well, the inflation is sticking from 11% to 9% now. So let's go ahead and start lowering rates. So they did from 8% to 7 to 6. They got to the 5s, and they're saying recession ended. As soon as they lowered the rates to 5.5, what happens to the inflation? Boom! It spikes again, both inflation and unemployment. And then I just want to show you a quick picture of the dollar before we look into some more details. So 1973, okay, the title of this video was The Great Divergence on both fundamental scale, which is the fact that the current market conditions, while most people are still asleep, we are already in the recession, but most of the people still don't see it, which is the fact is what makes you a great trader, recognizing that it is already here. And if you take the right stance and the right trades and the right strikes and the right terms, this is how you create a fortune. But right now, I want you to focus on the other divergence, which doesn't surface very often in the market. And that is the correlation between US dollar and gold. We're going to take a look at multiple charts so you can understand the correlation a little bit better. It can also help you trade cryptocurrencies if you understand this correlation. I'm going to elaborate on that in just a moment. Focus in 1973. What happens to the dollar? From 109, it drops all the way to 98. So basically, dollar is tanking. Dollar is tanking. It does not pick itself back up in a meaningful way until we got Paul Volcker taking over the Federal Reserve as the chairman in 1979, 1980, 1981. This is where he really goes aggressive in the rates and the dollar's starting to take off. Until then, remember this, 1973, while they were raising the rates, okay, the dollar was actually dropping. Now, generally speaking, when the Federal Reserve is raising the rates, the dollar should be going higher, okay, because it gives more people incentive to keep the money in dollars because now they're earning more interest rate. Okay, but understand this, this is not what was happening in 1973. Higher rates did not stop the dollar from dropping. And this is very, very important in you understanding what the market is actually working through right now. In 1978, 1979, in late 70s and early 80s, the Fed was really serious about getting inflation under control. If you look at a time frame, which the most aggressive time frame of any Federal Reserve chairman is viewed as Paul Volcker. But if you look at this guy right here, William Miller, 1978 to 1979, it's only chairman for 1 year, but this guy did not miss a bit. I mean, look at this guy. He was on Viagra every month. Look at this. January raises the interest rate. April raises rate. Look, September, October, November, December. This guy is raising rates every month. Okay? Rate hike almost every month. And look, we're not just, look, I mean, okay, here's a quarter here. Here's a quarter%. Look, here's half a point rise. Half a point. Okay? I mean, this guy was not playing around. And what they do, they replace this Miller guy with Paul Volcker. Okay? And this guy, they're like, wow, this Miller guy is just not cutting, man. He's only raising rates by quarter point, half a point. I mean, damn. We need somebody who can really get this inflation in control. So Paul here says, well, you know, I mean, I can't just come in here and just start raising rates, you know, 3-5 points at a time. So at first he takes it easy, right? Quarter point, half a point, nothing different from what this Miller guy was doing. But then look here, like overall, if you look April for October, overall you got 5 points. 5 points. Damn it. Okay, and this was just the beginning of Paul. Okay, and he was like, listen, this is insane because he was doing all these rate hikes while GDP was negative. Unemployment was at 7.2. Inflation was at 13.5. And in this one meeting alone, right, October 8th through October 22nd, right, that 2.5 point rise in interest rates. 2.5 points. I mean, the market is getting edgy every time you're talking about a quarter point. Like, what if the rate hike was 10 times that? 2.5 points. So, but hey, this ain't nothing, okay? You don't know Paul. So this Paul guy right here, he goes, and look at this. 81. Holy shit. 81. They gave these guys some extra Viagra. He raises rates from 15 to 20. 15 to 20% in one meeting. 5 points. Guys, this is like 20 times the rate hike that the Fed just implemented. Can you only fucking imagine? Seriously, just can you only imagine what would happen to the market if they raise the interest rates 5 points in the last meeting. Okay, this would be, oh my God. Okay, so he doesn't stop there though. Okay, here's the kicker right here. I mean, this shit is unreal. This guy, October 13th, so he raised it to 20, a couple of rate drops here and there. We're at 12%, 6-point raise, 6 points. Whew. So what I'm saying, the current Federal Reserve team, they're not serious about raising rates. I mean, you can clearly see when someone was serious about getting inflation in control, when you have 5-point hikes in the meeting, 6-point hikes in the meeting. Like, this Fed is just saying they want to raise rates, but their actions are actually showing exactly the opposite, and they're showing exactly the opposite for the very reason I've shown you on the first few slides, and it's the fact that their interest rates, Fed funds rates go above 5%, it's Armageddon, okay? Just the simple comparison, some of you can still relate to the housing collapse in 07, 08. Just remember, if the defaults were going to go over 5% on these mortgages, it was going to be Armageddon, and it was. So the same thing is playing out right now, but a much greater scale. The Fed cannot have funds rate to go above 5%. So they're going to slow pace it, quarter point, quarter point, quarter point. The moment there is a chance, any probability that I could be miscalculating something and the Fed announces 0.5 point hike, there's going to be a major, major move. But lower, of course. But what I am saying, you don't have to do a 0.5 point hike in one meeting. You can just continue doing quarter point and the market will unwind. I'm going to show you the charts in just a moment. So first, let's rewind the dollar chart. So now we're looking at the 1980s. Paul takes office for the Fed in 1979. As I just showed you on the slide, it raises rates just slightly. But this is where the rates really take off, right? 1981. I mean, this is where you got, you know, Fed funds rate at 20%. There's a particular time frame I want you to really pay close attention to, which is a period of the great divergence, which we're seeing in the market right now. Again, these analyses of these charts are between USD and gold. Most of the time, understand this, especially if you're brand new, you may not understand what is the typical correlation. The typical correlation is if dollar goes higher, gold should be dropping, right? Because gold is a good inflation hedge, historically. But if the interest rates are continuously rising, that gives people incentive to keep the money in the dollars. And therefore, dollar gets stronger. As a result of all these multiple rate hikes, okay, the dollars start really taking off. As you can see on this chart, when Paul Volcker took the office, the dollar it started having this highly bullish trend. But in this time frame, okay, this should be highly negative for gold. But this was the time frame where gold was also rising, which is what I call the period of the great divergence. And this is what the market is going through right now. We have both gold and dollar rising. Now, here's the kicker. The dollar goes all the way to 165 valuation in 1985. And this is where the United States government actually decides to manipulate the value of dollar. And you would think, especially if you're new, well, why would the United States want a lower value of dollar? Well, as the dollar value rises, if you are actually exporting something to other countries, it definitely hurts your exports. And now we're not making anything basically in the United States, so it doesn't make a huge deal of difference. But in 1980s, we're still making stuff here in the United States. Maybe not as much as in the 1910s or 20s or 30s or 40s and 50s, but that's when America used to be a great power. But now, the United States is still, in 1980s, it's still trying to head on to exports, and it's not working out because nobody can afford American exports. Stronger dollar makes perfect sense in current conditions where China manufactures 90% of the shit made in the world, and stronger dollar is actually allowing U.S. citizens to buy more of Chinese goods cheaper. But when you are the country that is trying to export, you want your currency to be weaker in relation to the country that's buying your stuff, because it makes selling to them a much easier endeavor. Okay, so in a nutshell, great currency manipulation in 1985, known as the Plaza Accord. The dollar tops. I've got this picture here on purpose because I'm really trying to show you. So as a student of the market, you really try to understand the typical correlation between the dollar and gold. So pay attention. When this artificial manipulation was made in accord with China and Europe to actually drop the value of dollar, it did work. The dollar did drop, 51% drop in 3 years. And what seems to be so puzzling is after the dollar already dropped so much, in October, the Federal Reserve got together. October 1987, actually was in September. The Federal Reserve got together. In October 1987, we have this huge crash. And this is actually one time the Federal Reserve was actually cutting the rate. So the huge 1987 crash actually happens after a rate cut. Damn! So typically people associate, well, rate cuts are good. Damn, this is the time to buy stocks. Well, hell no, not in 1987. So you should really go after and analyze all the market conditions before you go short or long on something. So this is definitely a case study for you to go and investigate further to really, if you're really trying to understand the markets better. So the key takeaways from this, I'm going to show you the next chart of gold. As you can see, this orange box again, this is the time when gold should be doing what? Dollar's going higher like a rocket, gold should be dropping. But correlations change in the marketplace for a certain amount of time. And if you can acknowledge those correlations, this is where you stand a chance to make a ton of money. So if you keep using the same correlation, at times at times things are highly correlated in the market. At times the correlation dissipates a little bit and it's just not as much correlated. And at times it goes away completely. And at times it is exactly the opposite of what it used to be. So understand the general correlation in gold. Gold should be collapsing here, but it's actually moving higher. So you have both dollar and gold moving higher, which is exactly the opposite of the typical correlation. Now, this is where the normal correlation kicks in. 1985 gold. Okay, this is the bottom in gold, which coincides with what? Look, 1985, the bottom in gold, and a rocket ship higher for gold prices. Okay, coincides with what? 1985 top in the US dollar. So dollar collapses, gold rockets higher. Now we're back to the typical correlation. This orange box is highly important because this is what the market is doing right now. Got dollar moving higher, while we got gold moving higher. Now in 1980s, the resolution of this clearly was the fact that after this orange box, gold started dropping and dollar kept rocketing higher. Now, in this particular case, in 2022, we're looking at exact opposite of this situation. So after the orange box, we're supposed to see dollar drop lower substantially, while gold is going to continue rocketing higher. And I've got high evidence chart I'm about to present you with shortly, so bear with me here. Now, also want you to understand the other move in dollar that has taken place, extremes in dollar, right? So in 1980s, they kept raising interest rates. The dollar kept moving higher to the moon, to the point of where it was like 160 plus. In the financial crisis of 2008, dollar hits a low of 75. So you have huge movements. And of course, financial crisis, what do they do? They cut the rates, they cut the rates, they cut the rates. I mean, they cut the rates to the point where they're zero, all right? And so you have two complete extremes here. Dollar at 75. In 1980s, you have dollar at 165. That's a huge difference, guys. That is a huge difference. And the importance of showing you this chart is to help you understand that dollar could be just as volatile as anything else that you trade in the market. And just for majority of the time, dollar clearly doesn't trade like Bitcoin. It's a lot more stable, but it is capable of making some significant moves. And most of the time, the significant moves to the upside or the downside will coincide with a major chaos in the markets, where the correlations are broken, where things are just not as they normally are. And the greater the speed of change in relation to the time factor, the greater of trading opportunities you will have. So this is what we're projecting for the dollar, because based off the 1973 historic analog, we believe that the market could sell off at any given moment. And for those of you that will say, well, hold on, Leo, the market doesn't drop in April. It does not do it. I mean, you can look statistically. Every analyst on Wall Street tell you the market cannot drop in April. I'm about to show you something that you should be 100% aware of. But we believe, due to the sell-off that's about to take place, the dollar is actually going to create a double top at about a 104 level, which coincides with a historic COVID crash, which we actually predicted on our channel, guys. We posted the video before this crash, before COVID was even invented. We pointed out that in the next 60 days, I posted the video at the end of December 2019 saying that the next 60 days, the market was going to collapse. And I was basing the analysis based off the charts, not based off my knowledge of COVID. I was looking at 13 market move sequences. I was looking at the chart and said, look, next 60 days is going to be ugly. And this is where the market collapses from over 3,400 points on S&P to 2,200. And this is what dollar reaction is. So clearly, as people are cashing out of stocks during the COVID, where does the money go? The money goes in the dollar. So the dollar rockets from 93 all the way to 104. Good size move. So we think dollar currently, this is slightly outdated chart from April 8th. Today is April 12th. But we're looking at a valuation on the dollar just at 100 today. And so still got about a 4-point move that we're expecting in the dollar due to the upcoming sell-off. And from here, after 104 level, creating this double top, which, by the way, when we say double top, could be up at like a point or two. But we're expecting dollar to actually deteriorate substantially after that fact. So you should know that financial system shocks happen when something drops sharply within a short amount of time. So the criteria for you to be trading actively and to be applying a significant amount of your capital to substantially increase your trading account size, the most determinant factor is time versus magnitude of the move. So, and right now in a position when the magnitude of the move in dollar could accelerate, and it could cause the market to create some insane opportunities in some sectors. And particularly, I'm going to break down the easiest trade that you could be taking, and that is the trade in gold. Now, we believe gold can hit 6,000. Right now, it's at 1970 as of today. Gold at 6,000 in 24 months. Now, it sounds a little crazy, but I'm going to say that this chart right here in gold is about as good as it gets. All right, we've got fundamental conditions are right. The dollar could still move higher, but I've just shown you, right, in 1980s where gold and dollar have been moving higher together. With the exception in 1980s, they had the liberty to continue to rise rates to the point of 20% on U.S. Treasury. But the Fed does not have the liberty to do that. So we're going to have a distinct shift in a not so distant future, maybe I'm talking about next few weeks, maybe as much as a month and a half, to where gold is going to explode. Now, it could start exploding as early as tomorrow, as early as, next Monday, after this Friday holiday. But this huge move in gold is about to happen because we're not talking, look, the more time frame you have on a chart pattern, the more valid it is. It could take a little extra time for the pattern to materialize, but these cup with a handle breaks out, I mean, they're good for 30-40% within 3 months. I mean, we're not looking at like a cup with a handle over a 6-month time span. We're talking about a 10-year cup with a handle on gold. Now, this is meaningful, okay? This is highly meaningful. And if you're wondering how I'm coming up with a $6,000 valuation for gold, besides this highly impressive chart pattern based on time frames and the criteria, look, I've got this historic time frame of gold, guess where, from 1973, because that is the historic analog we believe is actually going to play out in the next year or two. As you can see, and this is like a 15-year chart here, so it may be a little hard to visualize, but if you focus on this time interval right here, where basically gold goes higher, then goes sideways, and then explodes higher, this resembles the cup with a handle back in 1973, but on a much shorter time frame. And look what happens to gold. It basically goes from like sub 40 level, it goes all the way to 200 bucks. I mean, that is over 3x in 2 years. And so gold is just under 2,000 bucks, call it 1,900, 1,950. Guys, if you're a part of our alert program, I've been telling you to buy gold for the last week, 2 weeks. Okay, you'd be making good money if you got into these trades just a couple of days ago. I mean, gold is up 70 bucks in the last 2 days alone, and don't miss out opportunities like this. That's all I'm going to say. And if you don't know exactly, what strikes to go with, you should give us a call, guys. I mean, if you're not making crazy money in the market, the ones that I'm showing you in the trades that I posted in the videos here on this channel, guys, you're missing out. The market is a lot more than making $500 a day. It's about catching these waves of opportunities that don't come around very often, but they have insanely high probability of materializing. Okay, and so this is one of them. This gold chart got a historic analog. We've got a very high probability matching pattern here. And we know the time frame of when that move is likely to happen. Now, remember, despite of how bullish you could be on something, despite of how great the charts could look, I mean, there's still going to be pullbacks. Look, I mean, here's a pullback, here's another pullback, here's another pullback, right? But there's time to buy pullbacks, and there's time to short bounces. And so in gold, you want to be buying every pullback because overall, if you focus on this cup with a handle, the major move is going to be to the upside. So if you take the current valuation of gold at like 1,950 times 3, you get to about $6,000, all right, which is essentially the historic analog that we're looking at here. 1973, 1975, it was more like 3.3, 3.4x over 2-year time frame. So very simple, very basic, but this historic analog, based off the interest rates I walked you through, guys, it's beautiful. Now, within that same time frame, remember, okay, not every time the market crashes does gold go higher. But based on the historic analog, these are the conditions. While the market's going to drop, gold is actually move higher. Remember, in the COVID crash, did gold go higher? Hell no. Gold crashed with the market. It went down from like 1,800 bucks down to like 1,480 in the same time frame. And so gold was not moving higher, but it's important for you to understand when is the right time to be doing what on gold, to be doing what on the market. So you want to be short S&P, you want to be short NASDAQ, you want to be long gold. These are simple patterns, these are simple trades. All right. And that's for those of you that are skeptics that are brainwashed by the media, like, hey, the market can't drop in April. Well, here's a chart from April 2000. Whoa, hold on. I mean, that looks like, holy shit, look at all these red candles. Well, damn, that was in April? Hold on, when did that start? Oh, wow, that was April 12th, 2000. And then through April 17th, the market just keeps going lower and lower and lower and lower and lower. Damn. Where did you find that chart, Leo? Well, shit, you can find that chart too if you go to your thing you use for charts. It's there, guys, all right? And look, it starts out at a small drop, kind of like the ones we had in the last 2 days, and it accelerates, right? The drop is actually accelerating. So if this is a perfect historic match, you should see an increase in the drop of S&P shortly. And I know typically a holiday weekend like we have this week, like Friday the markets are closed, okay, is not something that you would normally associate with a market dropping. But trust me, pay attention to historic analogs because they will play out and the market can absolutely go lower in the month of April. Now, what's equally true is the market could also have a rather good sized bounce. So the idea is to catch the right moment, and that's why I invite you to work with a 13 Market Moves coach. Go to 13mmtv.com, schedule a 20-minute coaching call, and get yourself going in the right direction here. Now, great deglobalization has just begun. The key criteria from a fundamental standpoint to actually focus on here is the fact that the broad market has not reacted yet. The deglobalization is already here, but the market, no reaction. Okay, so we're looking at decrease in private sector spending and the collapse of UAE printing machine. I mean, that's quite obvious. Okay, number two, cost inefficiencies in every sector equals less production. Well, you can't sell what you can't produce, and you certainly can't sell what you can't produce that you don't have the demand for. So, guys, shorting stocks like Tesla is a no-brainer. It's an absolute no-brainer. And if you're a Tesla bull, you should go watch one of the videos where one of our students made over a couple of $1 million short of Tesla. A few guys made a couple $100,000 going Tesla alone, but have you made a few $1 million on Tesla going long? Of course, it depends on the size of your account, but let me rephrase this. Have you taken $100,000 and made $3 million long on Tesla? Okay, if you haven't, you have an opportunity to short Tesla with $100K right now and make $3 million. If you don't know how the fuck to do it, again, 13marketmoves.com, schedule a call, talk to a coach. Now, let me just summarize what all of this is boiling down to. We're going from here into a higher unemployment state, lower USD. Now remember, USD could still rocket higher to that 104 level, possibly 105, and then it's going to have a substantial move lower. Ultimately, high unemployment, lower USD is going to impact companies' profits. Okay, we're looking at a lower growth period. All right. So a lot of companies are going to be impacted. I'm going to be outlining some of the easy ones, but you know, when I suggested everyone in the alerts to short NVIDIA when it was up and high, it already came down quite a bit. It seems to be Wall Street, from Wall Street down, from Wall Street top favorite stock to, you know, Wall Street most hated stock. I mean, that's what stock market is about. I mean, you sneeze, you lose. I mean, you can't just be highly bullish on something and then it's down, you know, 30% in 10 days, right? That's the kind of market we're in. The market sentiment changes rather rapidly. So what used to be the favorite stock that everybody was loading on now is the greatest stock of pain for the market, meaning everybody is getting out of that stock for the same time. Not that NVIDIA is not a bet, is not a good stock. It is. Not that NVIDIA is not a good company. It is. All right. The point is, everybody owns it. And when everybody unloads it at the same time, what happens? It drops. And that's where you make a shitload of money. So just think of semis like this. If I was to summarize it real quick, okay? The whole idea for shorting semis, okay? Missing a lot of ingredients that go into manufacturing all sorts of chips. A lot of them, unfortunately, have to utilize materials that are no longer available due to sanctions. There's no other countries that are going to be able to replace those components. So, short semis, their sales are going down, the profitability is going lower. If they manage to replace those components, they're going to be replaced at a much higher cost. Therefore, their margins are going to be negatively impacted. And who in the right state of mind is going to be buying their stock back when interest rates are going higher? And you know your company's sales and projections are going to be going lower and lower over the next few years. So, checkmate on semis. You should be thinking, why didn't I sign up for 13 market moves a couple of weeks ago when we made the call to short semiconductor stocks? And make sure you don't miss out on the next few sectors and specific stocks, how to trade them. I'm going to basically break down what deglobalization means for you as a trader. You short China. So they sanctioned the shit out of Russia. Okay, who's next? Like, it's not the fact that the sanctions are placed on Russia every fucking day. The question you should be asking, okay, who are they going to sanction next? Read between the lines. China just sent a bunch of weapons to Serbia. Now, why would they do that? Well, United States in 1999, just learn a little bit of history, bombed the shit out of Serbia. Okay? Nobody makes any claims, oh, United States was, violating human rights. Nobody gives a shit. Why? Because it was United States bombing fucking countries, not Russia. So, why would China be involved here? Well, while they're bombing a bunch of civil people in Serbia, United States actually managed to blow up a Chinese embassy. Surprise, surprise, China just sent 6 planes of weapons to Serbia. Now, if you don't know where Serbia is, it's pretty damn close to the conflict in Ukraine and Russia. So if you don't see the big picture here, okay, which means translates into trading terms. I don't like to get into politics a lot, but this one just screams to be translated here. So basically, you short international stocks and you long local stocks. The only stocks you actually long is the ones that don't depend on any international components. Companies that actually manufacture something inside of the country where you reside, okay, whether it's United States or other country, Canada. You want to focus on countries that are not in any way dependent on this international deglobalization that's about to get worse. And clearly, deglobalization means short travel stocks, which every analyst on Wall Street is bullish travel stocks. You gotta love it. You gotta absolutely love it as a trader. Every idiot on Wall Street wants to long travel stocks, okay? Just as these stocks are about to report the most fucked up earnings over the course of the next year. Travel stocks. Oh my God. With the fuel prices consistently rising and fixing to rise anymore, why the hell would you want to be in airlines or any other sort of travel stocks? Short auto sales, okay? Again, you can't sell shit that you can't even manufacture. It's simple. On top of that, auto sales get hit twice. Not only they can't manufacture shit, but now they got to fight the high interest rates, which makes the monthly payments higher for the public. Good luck with that. The natural outcome, you want to long stuff like wheat, which a lot of it is taken out of the marketplace due to current worldwide conditions. Natural gas, gold, we've broken that down. Okay, here's another chart for those of you disbelievers that say, well, the market can't drop in April. Here's April 2001. Drop 1, drop 2. Beautiful, and look at the time frame. Again, the way you make money on weekly options, something has to drop within a very short amount of time for you to make a killing. December 2007. Now, this is a tornado pattern. Okay, right before what? Right before this. Now, in 2007, 2008, we actually had a double tornado pattern. Have 1, 2, 3 tornado, 1, 2, 3 second tornado. You got double tornado pattern translates into 15% drop. 15% drop in what? a month, guys. It's 30 days, 15% drop in the market. Remember, earlier I had you remember 50% drop over the course of 12 months. Now this is a 15% drop over the course of 30 days. This is what the stuff that gets you really paid. Now, December 2018, another tornado pattern. I hope you can see it. If you can't see the tornado pattern here, guys, you've got to take the Crypto Star course by 13 Market Moves. It's actually going to break down the tornado pattern. This is the most brutal pattern. Okay? This is the pattern that allows you to make 10x, 20x, 30x type trades. If you don't know this pattern, you trade without it, no wonder your account ain't going nowhere. So here it is, the tornado pattern. Can't see it. 1, 2, 3. Watch what happens next. Done. 1, 2, 3 tornado. Boom. There it is. Okay, 11% drop. All right, guys, what's the time frame on this? It's less than 30 days. So now I have given you 3 examples, right, of where the market could be going short term, 30 to 90 days. We can easily get, based on the tornado pattern, we can easily get 11 to 15% drop in S&P. Now, if we're looking longer term, we'll look at 1973 type pattern formation. We're looking at a 50% drop, which is not a big deal because not so long ago we were at 2,300, 2,400 due to the COVID crash. It wouldn't be surprising at all if we actually revisited those levels over the course of the next 12 to 18 months. Now, learn how to short stocks. That's the main message of this video. Hopefully learn something, but if your aspiration is to be a greater trader than what you're currently at, make sure you learn how to short the markets. Now, 13 Market Moves prides itself to be the best short selling type strategy ever in the world. So if you want to learn from the best, learn from 13 Market Moves, 13mmtv.com. Get your education, get working with a coach, take advantage of current market conditions. Let's roll. I'll catch you in the next video soon.